Vega, we cool.
Pickleonia.
What's up, guys? DRS AMC shares seem like free infinite money glitch. This stream brought to you by the bag holders of defaulted debt. I was gonna do a whole thing where I like flicked the camera and was like, "What's up, Moon Gang?" But then I hated myself for thinking about it. Anyway, April Fool's joke over and completed. Was AMC the real Moana all along? No. And don't listen to whatever Jay Fresh says later. Oh, you rascal. I know. Okay, everyone stop talking about AMC now. The joke's over. Ah, it was funny. I'm pretty sure Trey has finally taken his full-time gig as a commercial truck driver. Right? Although, I will say, based on the attendance before I started the stream, some of you people are still holding fucking AMC and lying through your goddamn teeth. I see you now. It's okay. It's not the one saying not me. Of course, right? Because no one on the internet's ever lied. All right, let's talk about things that are actually important. It was pretty obviously an April Fool's Day prank leading into the stream. Yeah, but you figure people who own AMC are probably easily tricked, right? One might even call them gullible. So what do we want to talk about? Do we want to talk about the bull market? Does everyone want to ask me, like, we could start today by everyone asking me about their shorts. And are their shorts dead? What do they do with their dead shorts? How could I let their shorts die this way, right in front of them? Why did I stab their shorts to death? Are my 14 DTE puts safe? Tell us about the guy from JP Morgan you tried to milk this weekend. I like how you phrased that. He got drunk and then got taken away by one of his younger family members. And then I don't know where he went after that. There was an open bar. It was fun. The money printer go burr once again. No. Is this a bull market? I'll just get out in front of this. No, I don't think so. Can we go up more? Sure. Yeah. Are my 150 DTE puts safe? Probably. Yeah, that sounds like you got plenty of time. Have I answered all the questions now? Hey Greg, long-time poster, first-time watcher. If my shorts are totally blown out, can I still donate them to Goodwill afterwards, or are they going to the landfill? I mean, you can try. Is this a signal that we're getting rugged when chat is concerned with their short position? I mean, chat's always concerned with their position. It doesn't matter what it is. They're concerned when their positions are up. They're concerned when their positions are down. It's just constant emotion. What are you planning on doing with your 421 SPY puts, SPX puts? Trying to decide if I should eat the loss or roll into 519 puts for more theta for SLD, CPI, PPI. I might move the 3850s out, but probably only if we test 4150, which I'm not sure it's something we're gonna see. A significant amount of the puts to the calls to the upside on SPX are sold, and if there's anything that the last 3 days guarantee, it's that people are going to want to take a lot of profits, especially farther dated calls on SPX, because the Vega bump is insane. Big theta puts better on QQQ or SPY. QQQ is a little more blown out right now. It almost touched Gamma Max on Friday. And you know, that kind of behavior in an index almost makes me think that this is more of like a squeeze kind of event than it is any kind of sustainable run. My 60-day now 28-day puts safe. They're not in a bad position, but you are starting to run out of theta, and theta is going to get worse for you from 2 days ago forward. All right, 3900p with 2 DT safe. No, you're fucked. Do you think there's a possibility of 4200? I don't think, at least not yet. As positioning moves in and changes, tomorrow and the next day, it's possible that we see enough interest come in at 4,200. But right now, no. Thoughts on the oil news this weekend? I haven't seen it. I've been drunk and in North Carolina. I think there's already some problems with oil, so if there's more problems... Oh, I think Dork mentioned something to me about a bunch of countries came out and said that they're going to cut production. That's really good news for my Oxy position. Head and Shoulders, long-term SPX and ES forming a neckline at about 3860, huh? No. The neckline on this would, well, sure, but I would say it's a bit lower. Probably like 3,700. Since it's slightly ascending. Are my BTU CCs safe? Well, they had the mine fires, so I don't know how far out you sold them, but hopefully that'll keep their pricing in check for a little bit. And the only way we're going to see a huge surge in commodities pricing is if we get like a hot CPI PPI print. But my strategy of kind of pulling back my BTU covered calls before CPI data has been pretty good so far. So where are we going this week? Retrace back to test some supports, or might continue to rip upwards? I would say that we have a pretty good chance of going down at some point in the next 4 days. I don't know how soon we're going to realize that. But I do know that when it's realized, there's going to be a lot of momentum. Remember that, a lot of these fluctuations in market price are the result of profit taking, right? If you get a lot of profit taking and puts become really valuable at the bottom, like, and you get stabilization, you get a very strong reaction to the opposite direction, right? Because like here VIX was like 30, and you can sell puts at massive premiums. You can go short vol at, a VIX of 30, basically. And obviously you want to take profits on long puts. So the combination of those two things is very likely to lead to a reversal. And so, it actually takes a very long time for momentum like this to bleed out of the market. So the more volatile the market gets within a range, and this current range kind of looks like here, right? The more likely that is to continue, right? And then, we're reaching a similar period here now because we've run up so hard. As it's the incentive to take profits on calls very high. The incentive to sell calls also very high. So yeah, it kind of goes, and that's likely to lead a pullback. Since we don't have large equity inflow anywhere, not in mutual funds, not in ETFs. As a matter of fact, we've only seen outflow. Then, the sustainability of something like a bull market right now is ridiculous. No one's buying any of the things that would make it a bull market. Everyone's buying treasuries and bonds. So we have money flowing out of equities while equities are surging. I mean, if anything, it's kind of really similar to what we saw going into, January when, me and JFresh and Dork were all, targeting like 4,200, right? Is we're seeing more of that, even more of what we were seeing then. Bunch of countries cutting production. Okay. As a novice to trading SPX, so buying 4050p 0721 be a pretty safe play, or am I regarded? I don't think that's I don't think the strike's very bad. It's kind of near the midpoint of our last 3 months of price action. So the chances of you seeing profitability on that position are really good. Especially bought, in the upper range. On any kind of corrective market action, you're very likely to see profitability, and you have plenty of time to realize that. So it's not a hard position to manage. I don't think it's bad. It's a lot of theta. It may be more theta than you need, but if that makes you more comfortable, go for it. BRICS make a dollar go ouchie. How will it affect the market? Here's the deal, okay? If a lot of countries, first of all, you have a bunch of countries that are arguably the least diplomatic nations in the world, getting together to form an economic pact with one another, which is already going to be fraught with difficulty, right? But then you have, Russia as at the center of that. And if Russia tries to move those countries to a gold standard, the US is going to sanction the fuck out of those countries and destroy their debt. Which will in turn destroy their economies. Because none of them on their own are sufficiently large enough to carry forward with that much economic damage. None of them are like rising stars in the GDP playing field right now. I mean, China's doing terribly right now. Russia's obviously doing horrible, and those are the only two that can put up any kind of actual fight. And then what's even more likely is other nations are going to get scared out of coming to any kind of agreement because of that. OPEC cutting every day. All right. I was in Cary. for a wedding. Would you feel XLE below 80 is decent or still too high? Take a look. Let me take a look. I think oil's still pretty cheap right now. I don't know if XLE is the exposure I would want. It's a little too broad. It's not a terrible price. It's kind of at the high end of where I'd want to see it, but like I prefer like 80. Oh, you did say 80. Okay, 80. Yeah, 80 is not bad. No, I'm not still in wheat. We could see futures peak overnight. It may not be during trading hours. I got home pretty late last night, but then I got some sleep. A couple hours. I got a 4050p that expires Monday. Hedge I didn't cut. Right now I'm thinking to average it down to break even. I would need to hit around 4070, 4080 pretty early on Monday to accomplish this. I mean, direction of futures into the over, like this morning, well, tomorrow morning's pre-market session will probably give you some idea of where that's going to end up. Gork, que paso con Netflix? Let me pull that up. If we're experiencing a similar squeeze type of run up we saw in Jan, how long do you see this continue to stay this way maximum? Like until mid-May? I mean, surely we'll test low points by the end of June, right? Like 3,500 or something. I don't see quarter one earnings doing anything good for the economy, and a lot of people forget that the Fed's effect is strengthening the dollar, and with oil supplies being slowed down, and the effect of a dropping dollar on oil prices, the Fed will only be even more encouraged and probably politically pushed to increase rates again, and maybe at a far more substantial rate than we have seen so far this year. I'm thinking, if we get hot inflation, which we may not yet, we may not get hot inflation until May, or we may not see it start to heat up until May. Yeah, the Fed's really going to be in a position where they need to raise rates higher. But if we get hot inflation, oil prices are rising. Yeah, I could see the Fed. I could see the Fed reacting to that pretty strongly. The Saudis have so much money. Yeah, but our money. I got 450p that expires Monday. Hedge I didn't cut. Okay. Oil limit up Monday after 1.5 million production cuts. It could. There's probably ways to play that. Gosh. It'll probably just open too high, honestly. All right, so Netflix. Netflix is breaking through its support here. I mean, 352 isn't out of the question. I've been buying, like June puts at 325. I don't think there's really enough upside here to play unless it breaks 350. In which case, yeah, it may be worth picking up some 350 contracts to see if it tests or breaks. I may do that. You know, with the potential to test like that 30-60 range again. So yeah, I may pick some of those up as a hedge and just something, you know, profit off of so I can average down those 325 puts later. But I think June is more than enough time. My only problem with that is this could kind of peak at like 352 and then fail, and you got to be out of those calls really quick. So it may be more advantageous to just wait, let it run out, and then buy the puts. Or at least see how it reacts to the test and how the market proceeds. Like, I mean, if we have the exact same price action Monday and Tuesday that we had on the market Thursday and Friday, you know, we're going to be at like 42.25 quick, right? You mentioned how the collar roll end of quarter could have contributed to the pump last week. How similar is this to end of March and end of November last year? Well, really similar to the end of March, but not similar to the end of November, given that, well, November has another one of their hedged equity rolls. So there's actually three, right? And so basically at the end of every month, there is a collar roll from JPM, but you know, the F-Man and JJow are weaker. So these are much smaller collars. And the MJSD collar is huge. That was no pen? That's weird. There we go. What if market participants are all highly regarded and everything pops like NVIDIA? Buy calls? What do you make of the Fed's hikes versus market pricing? There's such a disconnect between the two. Who do you think blinks first, and has this happened before, say in 2018? I think there have been some similar situations. You know, the market's still pricing in Fed cuts for this year, like pretty big ones. I don't think we see any federal rate cuts unless there's a crash. So the question is really, are they pricing in a crash? Because J-Pow already made it very clear that the Fed isn't going to cut rates this year if conditions remain the same as they are now. It's pretty obvious, you know, when you look at PCE, that inflation is not going down, right? If anything, it's flat and more likely slightly rising in some areas, right? So, you know, consumer costs are up, especially if you kind of move the weighting around and look at the raw data. And so if they're pricing in a crash, that kind of makes sense because, you know, if we get a massive equity failure, right, and market falls off, you know, down here, the Fed's in a really advantageous position to, you know, lower rates by like 1 to 1.25, but then hold like a 4% federal funds rate into the end of the year until inflation is down sufficiently, right? And then they can begin QT when inflation nears zero, effectively becoming the boom bust cycle. which is what the Fed has always really wanted, was absolute control over the economy. And that would give them an opportunity to get it. I know you're getting a lot of how dead are my puts right now, but busy, so I'm just tipping to get an idea. SPY 400Ps, April 28th, negative 45%. I mean, it's did hedge some, but not enough. Double down or roll. You could probably give it a few days. We do have SLD coming up. We have CPI. We have PPI. You know, there is bearish macro on the horizon. Really, the only question is what's the labor data going to do this week? You know, if labor data is seen to be improving a bit, you know, that could further a bullish push into, you know, CPI, PPI, and SLD. So yeah, this week's kind of up in the air a little bit. Only because, you know, we've run so hard. Are we going to see immediate capitulation on the long side? And if we do, you know, that's going to drag us down really, really hard. Long dated puts are very cheap right now, which you saw with, you know, the volatility on the VIX on Friday. So people are definitely buying up long dated puts right now. While they're cheap and large numbers. But is the call interest going to hold, and how long is it going to hold for, I think is the real question there. And you don't have a ton of time. I mean, if it's like a big position and you need to manage it, I think probably the best way would be to get more theta on it instead of like doubling down. Getting more theta on it might be better, because then you can carry through the period of uncertainty. I mean, you technically have enough to see SLD, and you're not that far out of like the current trading range. So I don't think it's impossible for those to go in the money by April 28th, but I understand the desire to do something with them. I have like my 3850s, which are down about, you know, roughly 50% now, that I averaged down on Thursday, which is unfortunate. But I'll probably sell, like, if it looks like we're going to trade in the upper range for a little while longer, I'll probably, you know, sell some puts against that position. And try to offset the theta decay a little bit. But really what I should do with it is roll it out. Saudi 500k cut, Iraq 211, UAE 144, Kuwait 128. Okay, thanks DC. I still see a drop back to 3090p, but you didn't even ask me the price. You just named the put you're holding. I don't even want to get into like why the fuck you would be holding a 3090 put after we broke, you know, 4020, 4030, but it's possible. I mean, I don't know what CPI and PPI data are going to look like. We know that they're picking up some volatility, so the print could be within a wider range this time. But you know, while costs kind of stayed flat over the last month, there were some sectors that rose. With the new weighting, it's possible. I mean, how like shelter's been pretty flat, so that's unlikely to push core CP or CPI too much higher. Consumer non-durables are a little bit up, so, and food is up, so that could drive prices higher. So we may see. My concern is that we don't see a hot enough print for it to cause a reaction in the market. You know, if we see a inflation bump of like month over month of like 0.1 or 0.2. That hasn't really affected anybody much. Though the benefit there, though, is that we'd be seeing it going into SLD. The CPI report comes out on the first day of SLD. And moving into OPECs, obviously, when there's, you know, a fairly strong desire for, you know, profit taking anyway. I don't have a screener recommendation. I've tried FinViz and TradingView, but neither are really allowing me to do what I want for alerts, or I'm not using them right. I mean, FinViz should be sufficient for almost any strategy. If you DM me, there used to be like a really good guide to setting up FinViz screeners. I can't remember. I think it was on Reddit somewhere. I'd say DM me, but I don't want to hunt it down for you, so don't do that. Try to find it, I guess. Screeners tend to lead to a lot of overtrading. What about EpicCon? It's working now. So is it possible that Wall Street pricing in a crash? That might explain that they are rushing to squeeze the market as high as they can, 43, and then give us Black Monday somewhere in June. That's possible. Yeah, I mean, it's not really rushing to squeeze the market. It's more, you know, propping things up while they get out of equities. And then, you know, obviously, you know, short positions were fairly overextended on the last two massive drops. And so, you know, the combination of repositioning on the short side and this, you know, push to sell equities higher, leads to, I mean, this isn't like, you know, it's not like this is the first time we've been through this year. And, you know, in August last year, it was very sustained, and dragged on a lot longer than people thought it would. And I would say, yeah, sure, be prepared for an outcome like that, because, you know, that's only like a week, right? And, you know, in August we failed on SLD. So if we are going to see, you know, upside over the next week, just prepare for that. That's the best thing you can do, right? Is prepare for like maybe like a 4,200 test, or, you know, 4180. Because, you know, it could continue to drive higher as we see more and more of this. But I think ultimately, you know, this wasn't a bear market or a bull market. This wasn't a bull market. This wasn't a fucking bull market. And more recently, you know, this like 2-day spike, of which this shares almost every characteristic, also wasn't a fucking bull market, right? And while I love worst ampersand ever, what? We're doing those? For what? I wasn't drawing, I was just squiggling. So yeah, I think try to keep that in mind, is that, you know, these rallies, especially when they're as overextended as this one, tend to die off pretty quickly. And there's actually nothing bullish going on, regardless of how people feel or what sentiment is being pushed on the news. You know, and they're already starting to pull back, you know, the mainstream media talk of it being, you know, a bull market. It's not that I can't draw ampersands, it's just that I don't draw them very often. They're not like a common part of my writing repertoire. CPI is next week on the 12th, and SLD is the following week. No? SLD is the 12th, on the 12th, I believe. No, sorry. Yeah, CPI is next week. SLD is the following week. That's correct. Sorry. I have Netflix 421, 325. You don't have a lot of theta. 519, 315s that I bought when it was trading around 332. What are your thoughts on holding and exiting? I think you don't have enough theta on your 325s. So, you know, at the beginning of this week, I'd bought shorter dated puts on Netflix, right around here. Those got stopped out as it tested the my lower, here, let me go down to the shorter time frame so you can see the trade better. So, you know, I entered puts on Monday for short dated positions. This was my short-term midpoint PT, which, you know, is kind of like where I'm setting a stop, right? If I hit my midpoint price target, I'm going to have some stop in place in order to protect the profits I've realized so far. I got stopped out of those. 33, which I don't know how you entered unless you bought Monday and overheld. Okay, so that's what you did. You bought 421s on Monday and overheld. They're kind of dead now, right? You should have taken profits here, or at least set a stop. That's more than a sufficient drop of $10 to take profits on. So you got a little bit greedy, Ornate Pigeon. Your 519, 315s, those might have enough theta to be worth averaging down, but I would wait until you maybe look at the 35, 350 range. Let's say 350, right? And if this looks strong at the 350 range, you may want to protect further upside with calls. The problem you're going to run into here is it can keep climbing, like up to 3060, right? And since you're in May, you know, you may not have enough time for it to reach 315 on the other side, right? You don't have a lot of theta to realize the downside. So, maybe hedge, like I would maybe consider hedging now. And then if you get a rejection on 350, this would be a good time to average down puts. If you don't get a rejection on 350, you can cut puts and continue to ride the calls up and hopefully cover, you know, your losses that you sustained in this range. Does that make sense? Upstart on Reg Show. I know. It's pretty cool that every time the market bounces, Upstart goes on Reg Show. I like it a lot. But it's starting to be a little overly consistent and not leading to enough. So don't worry. You know, Upstart's not going to attract any institutional buyers while the Fed's still considering raising rates into the future. Once the Fed pauses rates, that's another story, because the credit markets can start to stabilize. And I'm just buying more. I'm trying to use like the small little bump that it's had over the last few days to sell some CSPs on. I think we're going to see Upstart get, you know, slammed back down with any downside market action. Remember, it's very illiquid, much more illiquid than GME. It's probably more comparable to GME. GME's like liquidity levels as we approached like the end of 2021, beginning of 2022. Maybe really specifically that period from like March of 2022 to through the split, where GME became massively illiquid. Upstart's like that every day, right? And so Upstart's positive beta tends to be very, very high. But that also means that when the market comes down, Upstart comes down very hard in excess of the drop in the market. You're excited for the data prints coming out of Japan tonight? I'm interested. I wonder how much more I'm gonna have to. I mean, right now I've got like a year and a half roughly on my positioning that I can just kind of sit through. In the next 8 months, I'll probably have to move something around. But, you know, Japan is consistent in their ability to quantitatively ease everything. It might as well just be a socialist country. Discussing your strategy rationale, the trader's possible mistakes during their trade for Netflix was helpful. Thank you. Yeah, remember that, you know, sometimes when you enter these, like, or at least the way I set up my charts, and I know this last week had some confusing ones because there were longer dated and shorter dated PTs, right? And, you know, we have like the solid lines here representing the longer PTs and the longer term risk profile, right? Which is going to adjust as the price action rises. So I'm going to move those up, you know, so now my midpoint price target is going to like move up in relation to the rise in the underlying. My long-term PT is going to move up as well because I want to make sure that whatever I'm buying in this new range, which the stock has moved into, I have sufficient theta in order to realize those price targets, right? And then also, like, anytime you are up on the position, you should have stops. Unless it's, and you know, I mean, obviously, you know, if you've got 6 or 7 months on your theta, you know, you can set your stop much wider, right? You could accept like 25, 30%, 40%, right? Because you can average these down. You have a lot of time for, you know, the price to kind of go up and move and fall back into your target range, right? And more time to confirm your thesis as time goes on. But, you know, if you're like 30 DTE or 14 DTE, you know, if you're profitable at all, you should have some stop in place, at least to minimize potential loss, right? So, you know, if you're positive 10% on your contracts and you have a stop at negative 10%, you know, you got a 20% range for that contract to breathe in, right? And if it continues to print, you can move this up till it's at, you know, even. You can move this up until it's at like, you know, 10% profitability. You can just kind of follow the trend, right? And adjust, you know, your total max risk as time goes on. But like this, where you know, it's in fact crossed the local price target. I mean, you should be ready to capture profits there. Especially when it turns around, right? Like it started turning around over a period of an hour. There's plenty of time to, you know, set a stop and capture what was really good profitability on the contract, right? Like, I mean, that's a $10 move. If after that, you're like, you know, this range is awesome if it happens, but it's just trying to just let it ride until it hits that target is just greed, right? You're letting greed like take over your positioning, and you're more likely to lose more often than not if that's your strategy. Now some of the Pickles picks last week worked out great. Like Caterpillar, you know, I actually got closed out of Caterpillar. Like right here, I just got stopped out on the downtick because my stop was so close, and unfortunately I missed out on Friday's price action. But I mean, I still set my stop at mid, right? And this can continue up, and we may actually see Cat hit the PT, right? But yeah, I got stopped out here. But if I hadn't gotten stopped out there and that had reversed, I could have lost all my money very, very quickly. Do you ever set stops earlier than 10% profit? I don't, because I have a lot of money. I don't really know any other way to put that. I can afford to be greedier. I can have a lower win rate, but at a higher win profitability percentage, and that's fine for me. But you need to adjust those ratios based on your port size. Yeah, I know you did. I bought some weeklies too. Once it showed some strength, like right around here, I picked up like 220 weeklies. I had to have something to protect the upside as my Nvidia puts continue to light themselves on fire in protest. Is now attractive time to buy far out of the money strikes on SPX SPY simply as a Vega play. These look attractive to me because of easier positioning size with my port. What DTE is best for this strat? 90, 120. I assume you're talking on the put side. It'll be very hard to sell them on the call side. So there are some like Vega call strikes that people buy, like 20, like I think it's the 2025 10,000 C is one of the more popular ones. You've got to kind of do some digging through the options chain to find out where, you know, the people that are playing Vega are playing, you know, either, you know, they're playing Rova or they're just playing straight Vega. If they're playing straight Vega, you know, those are like 3200s for, you know, June, September, 33,000s in June, September. These are more Rova plays where they're playing, you know, the effective volatility on row. Like the 12,000 C that I have that everyone likes to talk about. This has like a Vega of like 4.5, right? But because it's a call and very far out of the money, it also very far till expiration. It has a lot of row, and so, you know, there's a multiplicative effect between row and Vega. That, you know, acts as a multiplier on the contract premium. So if the Fed raises rates, the value of that contract goes up, right? And then, because, you know, calls become more expensive, and then the amount of theta it has, you know, there's an effective row on the cost of theta, and then the effective row on Vega. And so then if Vega spikes, the contract's premium moves up very, very, very quickly. But it's got to spike really hard. It's got to spike like 35, 40 on probably like 35, 40 on VIX. And then there's no one to buy it, right? You need to find someone who needs to hedge that particular contract. But yeah, generally speaking, you're looking at very far out of the money puts, probably more than 120 DTE. Hey man, you missed a Ko-Fi. Oh shit, sorry. Also, JPM sold put at 3260, indicating they might target that range by end of quarter 2. The price below their bought puts should max their profit above 3260. I mean, no, JPM just rolled their collar 5% from the money, right? 5,520, which is, you know, it doesn't actually indicate anything. It's, you know, it's simply a target range from spot. If they think the markets are going to remain volatile, you know, they'll fall into the higher range, you know, like 4 to 5.5% from spot. which means, I mean, the only thing this really infers is JPM expects the market to move in wide ranges, right? If they'd targeted 3.5%, which is the lower, like, you know, the underside of 4 to 3.5%, which is kind of the lower range of their allowed roll, then, you know, that would imply that they think the markets are going to be fairly stagnant. So they didn't max out the range, but they did sell in the upper portion of it. They are profitable below, what was the downside one? 38.85 now, I believe. So they are profitable on their puts below 38.85. Generally, if we see a market bottom on the downside of their puts, they roll like they did in October. So that's what happened. That was one of the big things that happened back in October, when the market reversed trend here. You know, we were under JPM's puts. So they rolled the collar. Basically, they closed the profitable puts, bought back the sold puts, and bought back the sold calls, and then repositioned. Do you ever give more thought on making a small port and growing it for the channel? No. I don't know. I could. It's boring. How do you think oil prices will affect FSLR price action over the next couple of months? I mean, energy sector going up can benefit FSLR, but it's more in sympathy, and then with like energy ETFs that they're both a part of going up. Mostly my short side bet on FSLR is they will not be able to meet their demand currently. This is kind of an ironic bear thesis. But I don't think their demand is so high, and they have so much money sitting on the side that I think they are overvalued based on that. Because to meet that demand, they're going to have to massively increase capex during a period of inflation, which is obviously not ideal, in order to bring their production capacity up sufficiently to meet demand. And I think for a period of time, that is going to lead to lower valuations. So I'm bearish because they're too bullish. The near-term price action stuff that I play on, it's mostly just because, like, I'm watching it a lot. So, you know, you notice more opportunities. For the same amount of money, do you think buying QQQ would make more profit than SPY or SPX? If we get a really steep correction or even a crash, QQQ will eventually crash more than SPY, right? I'm thinking about buying September 315p for a large amount of money and setting a PT of 260. Yeah, I think in the event that we do get a large asset sell-off, the margins I think are most at risk during a recession are going to be like mega cap tech, right? I think they'll, because their margin, their PEs are so overinflated right now. I think they stand to be the biggest losers. They're also, you know, ironically, one of the hardest things to short. But I I don't think it's a bad play. I wouldn't just move into it all at once. I would DCA over time. I wouldn't try to rush into the positioning. But you know, if we do hit a local high in NQ and ES and it looks like it's not going to hold, then you can enter a larger part of your position in what you think is the top, right? But make sure you leave some money to manage it, because anytime you choose a large position like that, you're going to want extra capital to manage it over time. Whether that be you need to roll it out, we don't drop sufficiently in time for you to realize your price target, or you get other opportunities to buy in cheaper. It's always good to have that there. Or if we fall halfway to your target and then we get a bear rally, you can hedge the rally. Have you discussed NVDS at all? Do these types of inverse tickers have anything to be careful of? Yeah, they have volatility decay, which lowers their value over time. So they're not the best buy and hold. And you need consistent declines in the underlying over a long period of time, generally, for them to reach equivalent profitability to just going short the underlying. And even longer declines in price, like, multiple days and days and days of decline in order to exceed the performance of the underlying. Suppose I missed a Ko-Fi, so let me go check that out. Oh, okay. Oh, sorry, Steve. Didn't you ask me that on Friday too? I feel like you asked me that on Friday, or a similar question on Friday. Maybe I'm losing my mind. What would you do with a bear credit spread 40, 30, 4,000 for 421, down about 40%? I'd like to wait for SLD to roll or just close, but I fear it'll be down far more even after SLD. So bear spreads. I just went over this with someone. So you can leg into a put back spread at or out of the money, at your strike, or slightly out of the money from your strike, by buying like in the money options at a ratio of 1 to 2. And that gives you like 1.3 times the net delta of your spread. So if it continues to move up, you're profitable. At which point you can close your hedge and then ride out the rest of your spread into expiration. So you can do either one. You can leg into a back spread, which obviously isn't as great, or you can buy in the money options. One option for 1 to 2 on the in the money option to the spread. SPX 1221 collar roll versus 323 roll on Friday looks somewhat comparable. Obviously not something to rely on, but seems like similarities. I think there's a lot of similarities. I don't think that the current price action to the upside is sustainable. It's one of the problems I had hedging it. I actually lost more money on this than I should have. Simply not wanting to buy more, like not wanting to hold longer dated call positions. I still think they're extremely risky. And I have mostly enough theta on my other positions that I'm not too afraid of a few more days of upside. The only thing I would really worry about is moving into a range where my downside targets aren't going to be realized. And so the answer to that is to roll up my strikes, right, and bring them closer to the money, which I started doing on Friday a little bit. Everyone in here seems to have gotten much more intelligent than when the stream first started, except me. Have you read Options as a Strategic Investment yet, Trina? I've heard you say in the past that candlestick patterns are bullshit. Yes. Yeah, I don't like them, right? They're nonsense because basically all you're looking at is the display of price data from the period you're looking at. So, I mean, I'd rather just look at the price data and the volume than try to make assumptions based on the shape of the candlestick. And most chart patterns are pretty bullshit too. There are a few legit to look for, like Head and Shoulders, and the rest are nonsense. So descending wedges, generally any continuous trends, whether that be up or down, are persistent. It depends on what you're looking at and the volatility of what you're looking at. But long-term trends hold, and they almost 100% of the time, all uptrends will break down and all downtrends will break up. This is given a long enough time period. This will always be true, right? Some things like Head and Shoulders, Head and Shoulders are about 78% accurate on like the 1 hour. There's a few things like MACD, if properly smoothed, can hit 70, maybe a little above, like 70xx% accuracy. But the biggest problem with using MACD as a signal is it has a very high success rate in specific ranges, like the 30 minutes to the 4 hour. The daily MACD is actually less reliable than the longer trend EMAs. So, and then weekly MACD is useless because there's too much information in each candle. So yeah, MACD tends to work best in this time period. So MACD is pretty reliable in the mid swing range. Head and Shoulders are pretty reliable. Inverse Head and Shoulders are a little less reliable. On the 30-minute, they approach like 65% if the volume profile backs it up. But you can have a perfect inverse Head and Shoulders, right, where you have both tests, but the volume profile doesn't support it, right? So you get high volume into the test, bounce on higher volume, then that kind of flattens out, and then you get a high volume downside that moves up into a higher volume upside, right? Then a low volume downside into a high volume bounce. This is very good. But sometimes you don't get this high volume bounce. It stays low volume. And then these can consolidate out and fail. So, I mean, a lot of TA is useless without looking at your volume profiles. And then once you start looking at volume profiles and price action, you've kind of already moved beyond or into more granular data than you were looking for with the original technical analysis anyway, right? And so now that you're looking at more granular data and more specific data sets, why are you still using technical analysis, right? It kind of becomes just way worse. Ascending and descending wedges, I mean, all descending wedges should have decreased volume, right? So from the fail, this should be the high point in the volume profile, and then volume should drop into the consolidation, right? And this higher volume period is what produces the peaks that give you the angle for your descending wedge, right? And then as volume drops off, you get more downside volatility, right? Which kind of gives you your wedge shape. Sorry, I kind of drew a flag. That's what kind of gives you that wedge shape. And then, you know, these break up pretty often. It's like 62%. But the problem here is that they can actually break up on a lot of volume and look really fucking good. And you'll get like this breakout, and then they'll immediately consolidate at the a previous resistance level and fail. Even if the volume profile looks good. And so I generally consider ascending and descending wedges to be traps. And I will usually take profit on any breakout of the descending wedge. I'll set stops here. And that way, if it doesn't continue to break up, which very few of them do, this is much lower. This is like 30% success rate. Maybe even like 23 to 30% success rate for you to see continued upside after that test. So I'll usually set a stop at any breakout. And that way, you know, if it fails, which is a higher likelihood, I'll get stopped out. Do you have any recommendations for reading for creating a future price target on a company? I mean, you just need to look up valuation models, and you need to learn how to calculate them. Depending on the company, you know, you can use FCF is always very popular. You can do like forward PE. There's several different types of EBITDA analysis that you can use. But you need to look up, you know, valuation models, and you need to learn how to calculate them. Ascending and descending wedge probabilities and volume profiles. How's Jamie looking this week? Likely have another run on Tuesday. Yeah, so I guess we could talk about GME for a second here. GME is kind of interesting. So, you know, there's a couple of things the data's telling us. One, you know, on the bear side, call interest is weak. And sold calls are high. So there's a lot of, you know, no, and there's a lot of puts. There's a lot preventing us from moving higher without, you know, actual buying occurring. But you know, our liquidity analysis and CV VWAP are kind of telling us that there's still obligations that need to be covered. And the market is moving up. So market upside plus, you know, internalized or offset obligations. I took a call position on Friday because I'm curious how this is going to play out. You know, before close on Friday, we'd actually uncrossed. And, you know, as the rest of the information came in, it looped back. And this will probably cross more strongly on Monday, but that doesn't mean that, you know, we can't revert right back, right? And if it does, you know, obviously I want to have some calls to hedge the CCs that I've managed to sell so far. I think if we do see a run from that, it'll be because SPX continues to surge up, along with NASDAQ and Russell. And B, I don't think it'll be very long-lived. Unless we move up to like $30 or something, it's really likely that if we get a liquidity realization here, it'll be very, very rapid, kind of like October 31st. I could see it being over in like 30 minutes because there's no FOMO or call interest there to sustain a continued run, right? Who's the special guest? We'll find out in a minute. Cap him? Yeah. You mean, you're the man, Gurk. Thanks for taking the time to slow down and teach some of the basic stuff. It goes a long way. No problem. Buy your calls back? I don't really want to. I mean, the long calls are cheap, and I sold my short calls at better IV than we have now. So I'd rather continue to make money on my short calls and just hedge them than buy them back. So that's what I've done. I've effectively hedged my short calls, most of which are at like $26. And I have $25 calls. Like I bought like 150, 25 calls. I think I hedged my sold calls in all the accounts that I currently have sold calls. I have some 1875 calls, but only 30. So I'm not really super worried. I think I hedged those in WeBull too, if I'm not mistaken. So I should be good across the board. Be honest, is Jamie Dimon the main character in this whole situation? No. I mean, he plays a role. JPM definitely has the favor of the government, far more than a lot of other big banks do. I mean, JPM's the one that I would say is truly too big to fail. All right, let me see what Dork's up to, and JFresh, if they want to come on here and say things.
Didn't have any great insight. They just cheated.
Yeah.
What's up, nerds?
Okay.
What's up?
Not much. JFresh, I know you wanted to pitch your bull thesis on AMC.
Yeah, I actually looked at your. I didn't look at your stream card today, but holy shit, man, it's perfect timing. Yeah, if you want me to just go into it.
Yeah, got it.
I might actually just buy like a few shares of AMC just to mess around with it. I mean,
you know, I just want to preface everything you're gonna say right now with are you aware that there are movie theaters that have not defaulted on their debt?
Yeah, that thought crossed my mind. Yeah, but you know, it's like, does it really matter? I mean, AMC's got you know,
the FOMO.
The FOMO, exactly. Anyway, I mean, it's all BS anyway. So what I was actually doing was I was, you know, pouring through the PCE data because I just kind of wanted to understand what was going on. And you know, they break it down.
Your puts are underwater.
Yeah, my puts are underwater, and I want to convince myself that everything is worse than the headline number led people to believe. So as I was pursuing the confirmation of my own bias,
nice.
I in fact confirmed my bias, which is always fun. I mean, so the thing that I wasn't quite sure first off was like, what exactly are the different, you know, the actual differences between CPI and PCE, because they seemed quite similar in that they're both looking at how much do things cost and how do those changes occur over time, but they're kind of looking at it from different directions. One is sort of a top down, one is a bottom up. CPI is looking at the price of individual goods and how they change over time, and then guessing at what the spread is on what percentage people spend on each category to try to come up with a, you know, an inflation number. And the CPE is sort of the top down. It looks at how much did everybody spend on all of these different categories, and then try to back out how much of that is due to demand, supply and demand, and how much of that is due to the actual change in value of the goods relative to the money supply. So they're both sort of imperfect. So the PCE just says how much did everybody spend in this area this month. And so, for example, this time around, the things that dragged the PCE down were energy, so oil and gas and natural gas and coal, anything like that. I mean, those things have been relatively cheap, and so people have been spending less on those things. But however, that could also just be simply that people are using less because demand is going down. It's hard to say which one is which. It's likely a little bit of both.
Yeah.
And so what I was trying to do was look at what are the things that everyone has to buy, right, versus the things that they can sort of choose. So
that's usually how they supposedly try to weight it.
Yeah, I mean, perhaps. I'm sure they're not completely stupid, and they're doing all this, but like, so for example, the total expenses went down on food services, so people are eating out less, or food's cheaper. I highly doubt food got cheaper, so I think what that means is that people are eating out less.
Yep.
Cars and automobiles are still going way down, which is dragging the numbers down.
Yeah, but they're not weighted as heavily anymore.
Yeah.
So the deflationary effect on cars, like used autos and new autos, isn't being felt as strongly as it was prior to Jan.
Yeah, which I think is smart, right? But those things are happening, at the same time that used cars, the loans are defaulting and repos are going up, and so that kind of makes sense. But things that you can't choose to buy, like housing and rents, are still going up quite dramatically. So
yeah,
I think I calculated it was month over month, it was like 0.8% still, which I was quite shocked by. I mean,
well, there was a study that I saw. I was just like flipping through shit, but I saw it over the weekend. It was saying that like the average American rent has reached like 40% of the average income.
Yeah,
which is
I believe it.
Nuts.
I mean, I was listening to some people looking to try to rent in like nowhere suburb of Atlanta, Georgia, like 2 hours away from Atlanta. They're talking like one bedrooms for like $1,500, which I feel like 8 years ago they were like $600. It's like, what the hell is going on? It just seems so ludicrous to me.
Well, I mean, a lot of that's also like Zillow and like Redfin, right? The surges in rental demand lead to faster price realization because there's now a consistent market.
Yeah. Other things we generally have to buy, whether you go out to eat or not, is food, and food is still going up at like 0.9% month over month. I know those are fairly volatile, but even looking back over the past 6 months or so, it doesn't seem like there's a huge spread.
No, not much.
And so the things that people have to buy are still going up, and the PCE is essentially just showing that there's now signs of demand potentially cooling in some of the outlier areas like cars, food, eating out. Those things are easy to drop. But one thing that caught my eye, there's a massive outlier, was going to the movies.
Can I have Sprite?
Yes. Going to the movies. My son is bothering me. That went up month over month, from Jan to Feb, 23%. Like, we're talking about all the other categories are up like 0.9 to 0.3. This went up 23%. So I was like, all right, maybe it's just like a seasonal thing. People are just, it's starting to get into spring. I guess it's February, middle of winter. I don't know. I don't know what the seasonality or the cyclical nature of movie theaters are. But I looked back, and over the past year, it's either year or six. No, over the past 6 months, it's gone up 16% month over month.
Yep.
I thought that was insane.
Do you want to know one of the first indicators of recessionary climate.
Probably that, right? Because
Higher spending on entertainment,
well, here's interesting. What
lottery,
went down.
and booze.
Yeah, lottery went up. Booze went up a little bit, mostly beer and wine, not so much spirits. But the thing that went down while movie theaters were going up were sports and live venue entertainment.
That's expensive.
And I don't know. I mean,
you could probably blame Ticketmaster for most of that, but
can you though? They've been awful for my whole life.
Yeah, that's true.
So anyway, yeah. I mean, maybe get like Regal Cinema. I don't know which one's doing the best, but I might pick up some AMC just for the lulls. Yeah, that's sort of what I was breaking down. I mean, because I was just looking. I'm trying to look for answers of what the hell is going on in equities.
I feel like a lot of it seems kind of obvious. I mean, maybe we should talk about like the gamma dispersion a little bit in the market over the last week. I feel like it's something that, you know, all the Twitter volfluencers or whatever the fuck they are seem to neglect pointing out a lot as they blame everything on market maker charm.
Yeah, this one wasn't really market maker. I mean, it was there, but it
was so small in relation to like the overall delta and actual gamma exposure that it's just like, and since VIX dropped, people are buying far dated shit, right? That's, you know, and a lot of the positioning was already really far dated. The charm wasn't like the pimento, you know, where we were seeing that massive spike in market maker charm driving things up.
When we were talking about charm, what was it, end of January or beginning of Feb or whatever it was?
Yeah,
we were basically flat, and it was just sort of gently trending up an otherwise flat market. That's where you can see those secondary effects like charm and Dana and all that other shit. But when the market's just going straight up, none of those secondary things matter. It's all delta and it's all gamma. Anyway, go ahead.
No, I agree. But yeah, I wanted to kind of bring up the gamma dispersion.
I'm not sure I even really know what the gamma dispersion is.
It's kind of a you know, CBOE's tracking of, you know, either your long the index, short the equity, or short the index, long the equity, right?
Okay.
And so if we look at that, you know, overlaid with SPX, you can see that, you know, over the zero line, people are, you know, long index, short equities, right? If you look historically, if you look at a bull market, you know, you're looking and very briefly, I mean, if you use this as a determinator for a bull market, we were only briefly in a bull market in 2021. It was very short-lived. And now, you know, gamma dispersion's really, really high. So people are extremely short equities, but very long the indexes, right?
Yeah, I buy that.
And so, well, I mean, this is kind of a sign of, and the growth of that from, you know, October of last year till now is kind of a sign of like that equity. It kind of lends some credence to, you know, the thing we've hypothesized multiple times, which is that, you know, they're kind of like pumping the indexes in order to sell or go short the equities. But as of Friday, the upward drift on that fell off.
I think the opposite might be happening though, and maybe in my data. Obviously, my data is shallow in this area, but you know, I've been looking at net flows in various areas, and all of these.
Are we having technical difficulties?
I don't know.
For 60 weeks.
Hold up. None of what you just said came through.
Yeah, Yeah, so I was looking at net flows. Can you guys hear me?
Yeah.
Okay, I was looking at net flows, and net flows out of passive sort of index funds and things have been going down for 60 weeks. Like they just haven't gone up at all.
Yeah,
So
that would make sense. That would track.
So people are pulling money out of these equity funds, dumping them into bond, dumping them into money market funds, which has only accelerated in the last couple of weeks because of the bank failures.
Yeah.
And so what is going on? I think it might still just be the story that we've sort of been hypothesizing for a while now, is that, and this is kind of the opposite of what you just said, but I mean, money's coming out of the market, out of the equities, but are getting pumped into speculation in large cap, mega cap, sort of, I guess, quote unquote safety.
I mean, that can also, like, this wouldn't, would kind of track that though, because, you know, equally weighted, you know, the top like 10% of SPY is probably worth about the same amount as the bottom 90.
Yeah.
So yeah, I could see the data showing both. It depending on how you look at it.
Yeah. So my current thought is that, I mean, there's generally,
I mean, this would really infer that people are going short equities and long derivatives on the index, not long the index, right? It would be contracts on the index, not like actually like long the underlying, right? Does that make sense?
So it'd be
maybe
like
the way I presented it was confusing.
Yeah, so
because it's saying what you're saying.
Right. It's like an underweight equity strategy, but with an upside hedge, right?
Yeah.
Okay. Yeah, that makes sense.
Yeah, I would believe that people are definitely going long derivatives. I mean, that's part of what's happening right now, is just the natural volatility. And, you know, looking at the options data that we track, you know, obviously we were going down when the banks hit, but we still had room. We still had some room to the downside historically, longer term, like sort of more October. And we had kind of gotten down to where we were in December. And, you know, my guess was, you know, that panic would continue to set in and we could probably push it down to around October, but instead it turned around a lot quicker than I expected after they shored up the banks. And so I think some of this is just, you know, short vol, you know, swinging back the other way, longs piling in on the back of some FOMO on AI and some people running to mega caps, but the long term trend is still people are selling equities and buying safer things.
Yeah. Bonds have been yields have been dropping fast lately.
Yeah, and I did catch a little bit of what you were saying earlier today while I was driving back from the grocery store, and I completely agree with your potential theory on why bond rates are so low on like the 2-year. I think it's because people just want to lock in whatever they can because they think it's all going to go to shit.
Yeah, I mean, I don't think anyone's like sitting around at, you know, like at fund strategy meetings. Yeah, nobody with money at fund strategy meetings is sitting around thinking, oh, you know, Microsoft's going to have 13% growth from this quarter year over year forward, because they know that's not true, right? And even though like margin compression is very slow to realize, but once it begins, it's extremely rapid. And that's something historically that I think was most pronounced in like the dot-com bubble, which a lot of our current market conditions are very similar to, right? We have these massive overvaluations carrying into a high inflationary environment. And when we start to see margin compression, you know, it's going to be probably very rapid. And I think quarter one earnings is probably where we're going to see that turning point. And I think that it's possible by like Q4 earnings at the beginning of 2024, we have seen margins completely collapse everywhere.
Yeah, I mean,
And if
we even make it
inflation
that
is still
far.
persistent at that point, we're going to see a massive surge in commodities pricing. And hot commodities can drive equities down even further.
Yeah, I mean, obviously timing it's impossible to
Yeah,
tell.
yeah, yeah. I'm just giving like
Yeah,
a range, but I think the compression in margins can happen very quick. Probably about as fast as we saw the Fed raise rates last year, right? Like 4 to 5
yeah.
months.
I feel like at this point the Fed is just trying to slowly implode the thing. The dynamics are already set in motion, and they're just trying to slow it down.
Well, I had a pretty
And
long conversation with Dork earlier today, and because of the type of like speculative bubble we're in and the increasing inflation, the Fed really benefits right now from being more aggressive in the rate hike to the point where we do have a collapse in asset pricing because it may be the only way they can bring inflation down now.
Yeah, I mean, that's pretty much kind of where we're at, right? Like you don't want to, like in terms of like rate cuts and things like that, like everyone's being really like, at least the money is flowing such that everything wants a rate, cut within the next year, at least one. But is the Fed really in a position to be able to cut rates within a year? I mean, if inflation does bounce back in the next 6 months, that puts the Fed in an extremely complex spot where they need to keep the dollar strong, and also reduce at least the price of assets.
I mean, speculation on the dollar is already sliding because people are hoping for a pause, right? And I think
Yeah.
the weakness that the dollar's shown since the beginning of this year might be the best indicator of what the Fed needs to do, especially if oil prices are going to be going up, right?
Yeah, and also, I mean, you look at the global backdrop. I mean, other central banks are still really deep in the tightening cycle. So, like, can the Fed really just back off and further debase the dollar and give inflation more of an opportunity to get further entrenched? I mean, that's a very difficult decision.
yeah, I
Yeah.
mean, all you have to do is go look at Doge right now.
Is Doge our economic canary in the coal mine?
Yeah, well, it's going up. I mean,
Yeah, crypto speculation is really high right now.
you're not going to get disinflation while speculative assets, the most speculative assets on the planet are pumping.
Don't worry, it'll deflate. Doge will deflate itself.
Yeah, it's an extremely deflationary coin and a joke. And,
Yeah.
Yet still has like the largest market cap in crypto.
Gotta love
like that. Yeah, I remember. The funny, I know this isn't like when Elon Musk was on. Oh, did you lose me?
Yep.
Oh,
When
sorry.
you were referencing Elon Musk getting on SNL.
Yeah, so when he was on SNL, he was pumping Doge, and then afterwards, everyone was excited about Doge, and he was trying to tweet at the creators of Doge, like, hey, me and my team of whoever's have been thinking about like making some changes to Doge to like make it better for this or that, and he's like, what do you think? And the guy just replies like, dude, it was a joke, I don't care. But anyway, yeah, it pumped like 10% yesterday. That was cool.
Huh.
But yeah, I don't see. I mean, there's just too much money chasing such speculative things right now.
It's hubris, is what it is. It's overconfidence and exuberance.
It is. I mean, I've talked to people who, just around that are quite smart people who just don't really follow the markets very closely. And I get the sense that they feel like the worst of it's over and this is a new year, it's a new opportunity. Things are kind of cooling and it's just a matter of time. And so get in now. Get in early.
Yeah.
Right?
I'm hearing a lot of that.
And I'm seeing a lot of that, and
I mean that's like 2008 all over again, right? That's like, everything failed and everyone was like, okay, that's the worst of it. We're through it, right? And speculation in the market picked back up and then everything crashed. As soon as everyone got their fucking money back in, it all went to shit.
Yeah, I mean, I kind of think that that's exactly what's happening right now. Irrational exuberance is something the market's always struggled with.
Yeah.
And it's arguably, in some metrics, never been more exuberant in the history of the market than right now.
Well, at least NASDAQ.
Yeah.
Oh, I mean, like retail inflows have been crazy.
It's a macro, from a macro perspective, it's a really big problem that people are seeking mega cap tech, which arguably has the weakest of all of the obscenely strong margins as a safe haven.
They also carry a lot of interest rate risk too.
Tons, yeah. And also need constant access to cheap capital in order to maintain the rate of growth they've experienced over the last 10 years. And that's just not realistic.
Yeah. But the extent of what the average investor is thinking is, if you look over time, just ignore all the times when tech bubbles popped. Those tech bubbles tended to be the store of wealth better than everything else, and so that's all they kind of focus on is they'll probably go down less than everything else. But now they're up 90%.
Not if commodities heat up.
I'm not saying it's true. I'm just saying that this is the
I understand the pervasive common thought. But yeah, I mean, in the meantime, no use in trying to use our tiny ports to fight back against the thunderous herd.
Well, that's another thing to discuss is how much more room does it have to the upside? And I mean, in terms of the vol swing, I mean, there's really just not much left. I mean, we're starting to hit gamma max on things that don't almost never go to gamma max.
Yeah.
And in the meantime, on the indices, the Greeks are actually trending down while the price is going up, which is actually quite unusual. And I'm not sure what it means yet. At first glance, it means something very bad, that the correction to the downside is going to be even stronger than the correction to the upside when vol turns around.
Most likely because, you have a significant portion of participants buying up, every far dated cheap put they can feasibly get their hands on and maxing out, Vega on the short side.
Yeah. I mean, the downside looks pretty compelling. Obviously, it's just a matter, I know a lot of people that don't have a lot of time on their contracts are very concerned. Obviously, I don't think it's, futures are going to open tonight and just like plummet 2%. We'll have a period of flat, but I think we're starting to enter that period of chop and not the period of straight up. But we'll see. I mean, there's still a little room historically, but I mean, the macro is so much muddier than it was in the past that I wouldn't be surprised. I mean, I've been betting down more than up for the last 2 weeks, but now, I mean, my conviction's even stronger that we're getting near the top and down is more likely.
I think we see, I mean, I'm not so quick to jump the gun, but I do think that we're entering a period of flat. I agree with that. And I think the range of that flat is pretty broad, because of, the profit taking and stuff. We can see, quite a lot of volatility, very similar to what we saw, back here where we had large amounts of profit taking and large amounts of repositioning. that could persist for some time, I think. Maybe before we see downside, might be like a week or two. But I think the moves are going to be pretty big in both directions. But I'd want to see how the repositioning of this move shakes out. You know, if we reposition, stabilize, and reposition strongly to the upside, it can keep going up, right? As you know, a bear market would. I'm sure it'll have pullbacks during that period, right? But ultimately, yeah, I think a strong reposition around now would be bullish. I mean, I don't think we should ignore that.
Yeah, I mean, you can even see it on the intraday too. I mean, the shorts are ready to get back in. You'll watch them. I mean, that's kind of like what we've seen. You know, it's a joke, but I think that this is actually describing the dynamic that's occurring. You know, everyone just jokes that we know that it's going to pump in futures, and then it's going to drop to the midday, and then slowly bleed up positive 1%, right?
Yeah.
But that's I mean, the shorts are basically waiting for the longs to tire out, and they're ready to jump back in. And you can see it like every morning. They're like, all right, it's today the day. And they start creeping in, and the prices start going down. And then they get some spike on the way up, and they all get scared, and they jump back out and say, all right, we'll try again tomorrow.
I mean, the shorts, here's the deal. I don't think the shorts are going to try to push till we're above gamma neutral, right?
We're above it.
Are we? Just
above it.
On SPX?
Mm-hmm.
On SPX?
We might be just at it.
I thought we
I think we're
closed.
just above it.
We might be.
Let me look. Make sure you're using the right candles. Hankinashi's lower. Let me pull it up here.
41.18, so just shy.
Just shy? Yeah, okay.
So I would say that we're probably likely to see above gamma max before a failure or gamma neutral. And generally, I do want to point this out. Generally, when we cross gamma neutral, the SPX does move up a little bit for a few days. It can be like 2 or 3. Sometimes it's like 5. But there's generally a period where we see a higher high in there before it actually falls off. When it does fall off, though, the fall off below gamma neutral tends to be really, really fast.
Yeah.
Which sets us up just about perfectly to start seeing big downside in the like SLD CPI period.
Yeah, it's just really, obviously, you know, this does look a lot like March of last year, where we did pop over it while delta neutral and gamma neutral were kind of trending down.
Yeah.
But yeah, I mean, it's just so, like, if you look at the other end, like SPY and QQQ, I mean, that downtrend is so strong, especially even like on Gamma Max. I mean, it just looks like it's about to plummet off the face of the earth.
I mean, me and Dork have been working on some stuff on the side. I'm sure you've noticed us spamming the Discord with what appears to be complete nonsense.
It looks a lot like MACD.
How dare you? But it would indicate that there's like a 70 to 80% chance that we've seen the top.
I think that sounds about right.
That we're either at the top, right? Or like, not that we can't revisit that. Like we can fall and then come right back. But this would also collapse as well, like the next upside, and then we would see further momentum to the downside.
Yeah, I agree with that. So, yeah, I mean, I know everyone's impatient and wants to see it go down.
I think my way of handling this is just gonna have a little bit of an upside hedge, play out the rest of the bullishness, and then compound leverage to the downside for when it happens.
Yeah. So basically, what every single other short is doing right now in the market.
Yep.
Riding with the bulls and
sometimes you have to ride a bull and save a cowboy.
Yeah. Well, for everybody who's waiting for the market to crash and for society to collapse, How dare you? It's very un-American.
Those are volatility bulls. Those are different. They have lightning.
Volatility bulls.
That's like those are Dork's VIX calls. His out of the money VIX calls.
Dude, Vega is such a fucking scam. I am not touching that thing for the next like week.
Rephrase that and change it to I'm not touching that thing till it goes above 21.
That's exactly right. And I'm going to buy 25 calls and it's going to go straight back down to 18.
Yep.
I mean, it's not a scam. It's a calculation.
Yeah, but I mean, I just call it a scam. But it's only like the VIX has been so fucking low that I really get bullish on it, and then it just goes lower, and so like I can't bring myself to buy.
It's silly. Well, I mean, a lot of the bullish.
Is it crime?
Part of that vol swing that we see in the market is people going short puts, like really low puts, which is what really drives VIX, right? And so
yeah,
those will close out when VIX starts rising. Those things will go underwater real quick.
I mean, yeah, that's kind of what I'm thinking. Like, I want to play VIX, but like, I think that index puts just still win. They up until like a pretty steep correction. I mean, the market has shown it is not willing to price up.
Here's something I've learned about the VIX in the like relatively like last 3 years that I've been trading it almost nonstop. Because you guys know I have like most of my portfolio hedge and like in the money VIX positions. VIX is extremely leading. If VIX continues to break like higher and higher levels, it'll like break out, right? Like it almost never does it like break major levels to the upside without having like a full realization. So like that spike to 30, and that's like why I sold my VIX calls there and didn't like wait for more, because and then once it does, it collapses really fast.
Yeah.
But you get so much lead time on entering like a long VIX position. I don't think like positioning when it's low is ever really. It's literally the one thing in the market where I think it's better to chase.
Yeah. No, in VIX, I mean, it would make sense that it would do that, because VIX is like as a calculation, it kind of measures the liquidity of the options market.
Yeah.
SPX like pretty far out. So once that liquidity starts breaking down, that would make sense that it would spike super hard, because trying to drum up, the capital to sort of bring things back in line takes some time.
Yeah.
Well, it's also fear-based a lot, right? I mean, that's why people use it as a gauge of fear. It's people trying to pile into puts, reacting to something.
Yeah, it's a little bit of both, right? I mean, that's what liquidity breaking down. I mean, that's just this now, because either the market is running out of money or can't match on to one, right?
Yeah. Well, all right, guys, I'm going to cut you off early. I got to go do some stuff.
Man. Have fun.
But yeah, good to chat with you all. Hope your viewers got some sense of the fact that the biggest value in the market right now is AMC. 16% month-over-month growth in movie theater expenditures by consumers.
Oh, you son of a bitch. Go away.
20x what just about any other category is seeing. To the moon.
Okay.
I hope
I'm going to ban you from the quant cord.
Okay.
All right.
All right. See you guys.
Later, man.
Bye, J-Fresh. Goddamn shill.
It really is.
Oh, man. I really do think that this is all just kind of part of the calm before the storm. What's been happening? Like the bond market. Did you notice the bond market just like all the volatility just disappeared over the last 2-3 days?
Yeah.
I thought that was really interesting.
VIX drops really fast. we just talked about this.
Yeah, it's just
If
It's
Gaff
just
was
that
on the call, he'd just be talking about Bitcoin, Randall. That's what he does. He sneaks into your VCs, and then he just talks about fucking Cardano for like 2 hours until you're like, fine, I'll buy some, and then it goes down 80%. And he's like, wait, no, you just need to buy more now.
Oh, God.
All right. Well, we could call it a day because I know we have other things that we want to do with each other. That's really not for the public.
Yeah, no, I am having some tingly feelings in my downstairs area.
Are you
But
having withdrawals? I'm already having
yeah,
withdrawals. Backtesting withdrawals are intense.
I mean, yeah, to wrap up, I mean, I guess my outlook is unchanged, honestly. It's still the same thing. And I just want to reiterate, kind of when all this stuff is happening, like if you're wondering, like, oh man, what's going on, who's thinking what, just remember that, like, this is really like just take a step back, be logical about it, ask yourself why, and try to figure out the why. Why is the market rocketing, why and destroying my puts,
I mean,
why am I getting destroyed by this? And you'll come to the conclusion that, I mean, I think, when you really take a close look at the numbers like JFresh did earlier, like that nothing's really changed to shift the actual perspective on the economy. Like nothing's changed, and so this run is just a run. It's not like some sort of fundamental shift in thinking, right? Except it kind of is, but not in the long term.
I mean, for me, it's just, a lot of it positionally looks the same as the run we just saw 2 weeks ago, where everyone was like, ha, fuck your puts, this is a bull market. And then, all the bulls disappear and everyone's like, where did they go? And the bears are left standing. And I think, I don't think this situation's all that different from the previous one. I do think there's a bit more confidence in it because we've had so many bull rallies this year, right? And there hasn't been like a long drawn down period, where we really stay at low prices, like back in December, where we were at really low prices for like an extended period, right? And then, the negative sentiment really gets a chance to build up because most people, including myself, are inherently bullish psychologically. And it's very hard to like not feel that way. And so the market tends to run with bullish momentum, especially when sentiment follows suit. And sentiment almost always follows suit. It pays to be patient as a bear, and you have to be, because it takes a long time to win. But generally, when you do win, actually statistically, short positions pay out far larger returns than long positions. Bulls get skittish very easily. Upside starts to not be realized, and they're like, "Oh fuck! I just bought all this shit, $200 out of the money, and nothing's moving up." And that usually takes about 1 day of not moving up. And then obviously bears prey on that question and sentiment. So unless this continues to rally above like the 4,300, I'm still pretty confident in my downside positioning. I will take advantage of whatever upside is available for the next couple weeks, and try to capitalize on it as much as possible. But I will probably be putting all of that money into more puts.
Yeah, for sure. I think that we really got through the big upside risk moment in I think January. I would conjecture that January was as close to a bull market as we've gotten since like 2021, just purely because the data started looking good.
Yeah,
And
it really did on a fundamental level. Things were looking a little bit better. And that pulled back hard when inflation started to print up month over month for the next 3 months, right?
Yeah, exactly. Once that happened, I think that the bull market went away pretty quickly.
Here's the question, right? And just because we have had this kind of lull in inflationary pressure, what if we get a bullish inflation print?
Bullish how? Like cooling or
Well,
bullish?
kind of like a local, like down, right?
Oh, I see.
Like we get 0.3 reduction in inflation year over year, maybe like 0.4 month over month in core. I think it'll go right back up, but participants aren't going to view it that way. And I think that's something that should be prepared for, because there could be a lot of volatility in the CPI print. And if you're unprepared for that outcome, you could really, really, really get burned.
Well, I think it depends on earnings too. Like if we're starting to see margins compress and then inflation starts
That's
coming
going to
down,
be before earnings, though.
Oh, is it?
Yeah. We get the CPI print
yeah.
next week.
Oh, I thought it was like, oh, jeez, I'm out of the loop.
Yeah.
Okay, so that changes things quite a bit. If that's the case, then I think that if it is flat to down, it's not going to lead to much in the market. There's just like with earnings season coming around, that's the real test, right? Because you're not looking at these numbers that are cooked up by some organization. You're looking at the numbers that are cooked up by the organizations you have money in. So like I think that as much as I want to say the inflation print's going to have a big effect, unless it's like a big drop or a big rise, I think it'll be relatively flat, maybe a couple hundred basis points either direction. But earnings, especially the big bank earnings, I think is where people are really sort of, getting their ducks in a row, covering FTDs. I mean, that's kind of like, I think across the market, we've been seeing a lot of housekeeping being done.
Yeah, there is. There's definitely a lot of pullback on short positions too. I mean, that's pretty obvious across like, well, especially the chip sector, right? We see that with Nvidia and AMD, even Intel, which should just be rocketing down after they pulled back their dividend and still have like a 6-year window till they have a fab built in the US. Like Intel should probably be trading around like 20 or 14, right? But everyone went short with the China cutoff, right? And then all those shorts got squeezed out. And they're pretty much squeezed out at this point. And now the longs are starting to sell, like more covered calls and getting a little less bullish. But if the indexes keep surging, they'll keep pumping it because there's no shorts in sight, right?
Yeah, it's definitely interesting, and I think that, like, honestly, the chip sector probably is not going to be hit too hard, by any sort of data prints. But with earnings. With earnings of big companies coming out, it gives you an insight into their future expenditures, on things like Nvidia. Its price is heavily dependent right now. All this value has been pumped in based on the prediction that their market cap is going to go up because large companies are buying lots of their cards.
Did you read Chat GPT's like founders fucking interview with the New York Times?
No.
That came out this weekend? That dude's a nut job.
Oh, Jesus.
That'll be funny.
Yeah, I see AI being a huge disruptive technology, just not in its current state, right? Like this Chat GPT thing's really cool, but there's a lot of wonderful things that can be done with AI that, still haven't fully been tapped. Things like biometrics, right?
Yeah.
We're working on that, but we haven't gotten that to the consumer grade. Like something like a headband that you wear that, analyzes your sleep cycles and then tells you whether or not you're doing the right thing, stuff like that. It's the potential's there. We just need the actual hardware technology to get to a place where it's affordable to create the things that consumers will use, right? And actually start putting market share into AI, right? Like right now, we have people trying like Google and Microsoft and stuff, and we've been seeing the results where their chatbots, kind of do weird stuff. Like Microsoft becomes sentient and tells you, sad stories about being a robot, and then Google's, tells you confidently wrong information. I mean, they're not really putting it in the right places because the market is so frothy that everyone just wants a piece of whatever action they can get, and that's not healthy for the growth of AI.
Dude, just trying to get his Nvidia puts to print by freaking people out. You think so?
I don't even have
Maybe.
anybody much right now, dude.
No,
I
not
have
you.
none.
I think he means the Chat GPT founder.
Uh,
Maybe.
oh, did he say some like crazy bearish shit?
He just said like a bunch of crazy shit. Like how his technology is gonna like bring about the end of capitalism, and
Well, that's bearish.
yeah, people, especially for capital markets.
Yeah, exactly.
Maybe he is short Nvidia. He could have just said that they think AMD chips are better. Like if he really wanted to, he was like, no, we just strictly use AMD chips.
Yeah, it sucks being in this kind of crazy frothy shit because yeah, if you're bearish and you just like enter a position sort of chasing the downside in a midpoint in the market, like it just hurts so bad when it moves against you.
Well, you get like if you try to confirm. Here's the problem with the market right now for a lot of like traders, right? Is that if you wait to confirm the trend, it's over.
Yeah.
Right? Like you've confirmed the downtrend, you're like, I'm gonna enter here, and then the next morning it gaps down, you're profitable, and then by the end of the day it's back up again. And you're like, fuck, I didn't exit my position, right? And then, then it surges even higher than where you bought in. And then you're really fucked. So you've really got to be ahead of the market trend. And even if that does mean going, long when things are dropping and short when things are rising.
Yeah, to an extent. You don't just want to trade like as a contrarian, but you definitely do need to sort of identify the trading ranges that are kind of being fought for, right?
Well, I can see it because people like tell me their positioning, but like when they tell me their positioning, I know, when they entered it, and like I have a pretty good idea of how fucked exactly they are because I've been doing this a long time. And it's pretty obvious that people are like waiting to confirm trends and buying in to the trend, and then not treating it like the chase and scalp that it is, but treating it like they've entered a long-term position at 5 times the cost had they entered while it was moving up or while it was moving down, right?
Yeah, that's definitely if you find yourself like, trying to chase the current trend, it's always important to identify kind of key points where it could, there be pullbacks, if it's like trying to figure out if it's a continuation or a reversal, like it's you got to put more effort into that and think, yeah, several days ahead, it's really important to not get caught up in the intraday moves and sort of zoom out to see kind of what ranges are being traded in. I've been paying way more attention to ranges lately, and it's been so helpful, helping me kind of at least enter positions on the intraday moves, right? Because you can sort of see, okay, this is probably the top of the trading range, and you get a solid price on your entry to like the downside or the upside. And even though you may see a slightly better entry like later on in the day or something, it really it's pretty insignificant. So it's important to sort of take that stuff into account, and the likelihood of reversals too, like at extreme points in pricing, that kind of stuff.
I mean, there's another use to those like ranges. I try to give everyone every week for the like where we're probably going to trade, and obviously the further into the week it gets, the predictive power of it weakens, right? But like if we're trading in this downside range, you're really doing great on your puts, right? Because like there's a potential for it to fall further off. But like when we start to move like here, this is a really good indicator that some hedge should have been taken. We'd moved up to the upside of the midpoint for the week, right? There was some pressure. Obviously, we'd gapped up to the upside of the week. We did not fill that gap. This should have been a good sign, and even I ignored it to buy calls, right? Especially end of day as we moved out of that upper range, because that that really does mean that we can now trade in a higher range, and the market can move up, right? And so if you're in a short position and you're trapped in a situation like that, and you see the upper range start to open up, especially on something so positionally controlled as SPX, that's a good sign that you should be long a little bit. If not that you need to shed your long-term position, right? But like that you should have some sort of protection in place. The same is true, if you're long here and, we move down a range, you should probably pick up some puts to protect against what ended up being a further move down, right? And then, when those puts print, you can take that money, and if you're still confident in your thesis, you can average down your put position with the extra capital, which will, bring your break-even point closer to the money, right? And that allows you to, and if it moves too far, you can just close your put position, and your profits from your calls offset your loss. And that's kind of just a really simple way of thinking about how to trade these levels. My reticence to buy calls on SPX this week until it was really too late, which was like Friday, probably lost me a pretty good deal of money. So don't be too overconfident ever. Just remember that the market is still chaotic, and it can move against you. And when it's giving you clear signs that it's moving against you, don't ignore them. It's hard to do. Even the most experienced traders fuck it up sometimes. And if you're not in a position where you can just throw more money at it to solve the problem, it could really damage your potential for a few months, where you have to rebuild your port.
Yeah, it's tough. I mean, especially with what was happening in the broader, like the broader economic context, like it was tough to see a face ripper coming. I mean, but at the same time, you kind of have to think to yourself, was it, and you learn, right? Like it's the important thing. If this kind of thing happens, you understand what you did wrong. And one of the things that I think that you and I both did wrong was we thought logically. And I think a lot of people made that exact same mistake throughout this run.
I even expected upside this week. I had hedges going into the beginning of the week to cover upside because I thought we were gonna trade up as calls came in till we hit a neutral point. I just thought that neutral point would be way lower, right? Going into the PCE data. I assumed a neutral point between like max like 40-50, right? And more likely 40-30. And we just moved way beyond that. And I closed a lot of my call hedges too soon, and then was reticent to reopen them because I was like, I don't think this is going to go much further. And then it did, in fact, go much further.
Yeah, it was a bit of a kick in the nuts. I thought kind of the same thing. So I didn't, it was kind of, so you and I have different trading strategies, right? You got those, you can manage upside hedges much better than me, but I was doing like 1 DTE overnight, like at the money call on SPY, just a tiny little hedge. And then I just kind of was storing that up. But as it did trade out of the range, those overnight hedges started netting me enough to average down my put position. And once I started trading out of that range, I started averaging down with my hedge. Because the timing gets better, right? I mean, potentially, right? Your opportunity becomes higher as that happens. So I just started averaging down as well, and then it made it so at this point, I don't need a huge pullback to get back to break even, right? I need like a retest of 400, 395. I'd be sitting pretty, right? I could get out at a decent cost. I mean, I don't know if I'd necessarily be like super green, but maybe like 5%.
Something I did do right this weekend, and I don't know how many people can actually do this, so it may not be applicable to a lot of you, but it may be applicable to some, or those who are carrying larger free capital or a larger margin. Is I extended the range of my straddles each night from Tuesday onward, from 14 to 21 to 30 DTE on Friday at close. So I'm still carrying a bunch of short bags. Obviously the call sides of the straddles printed really hard. But I got progressively more and more theta on those put positions. And less theta on the long position into the overnight straddle. And that's something you can do with a trend that's uncertain, is that you can, if it's moving against your primary position, and the trend is very strong directionally one way or the other, you can buy shorter theta on the trending side, right? And then longer theta on the opposite side, the losing leg, if you will. And that way, when a correction occurs, you're still pretty safe on your short leg, and then you can close that out over a longer period of time instead of just, closing your straddle the next morning. And that's something I kind of do, generally speaking, anytime I think the market's going to reverse direction strongly. I know a lot of you remember like the pimento, and when I did that during the pimento, I was buying these like really far dated calls every night, but very short dated puts. And
Yeah,
what
you
that allowed me
basically,
to do was like I could take my put profit every morning as the market continued to trend down, right? And I could pump that into averaging down these long dated calls for when it inevitably turned back around.
yeah, that's basically what I was doing, but I was using like as little as I possibly could, whereas you're reducing your risk a little bit.
Yeah.
But I mean, you were probably going with your straddles or strangles. I mean, you could go at the money with those too. But I mean, especially if you're versus a strangle with more theta, I just thought, especially when the market's gapping a lot, at the money is fairly low risk in a trend.
Yeah,
You
it
know,
is.
if it gaps up once, it'll gap up again, and then within the first 30 minutes of trading, you can generally exit your call side hedge
Yeah, when
solidly
profit
profit.
taking occurs.
Yeah, exactly.
I mean, that was the thing that probably fucked me over the most this week is, I kept taking profit on my call side in the opening trend, which Friday was amazing, right? Because we opened with so much momentum. But like Wednesday and Thursday, it was kind of shit, right? And I would have been better off holding the call side into the end of the day.
Yeah, but I mean, you're doing the right thing by getting out of it early in the day. I mean, if with a low theta, contract, it's just the right thing to do, and it sucks when you missed out on opportunity. But I mean, you'd be assuming a lot more risk by holding it throughout the day.
Yeah, I agree. And so, yeah, by
So
doing that, you set up, I just want to point this out. By doing that, you set up your puts in a staggered way behind the price action, right? And so then when the price action falls, it's very easy to net these out or even profit off them if the fall is great enough, right? So, if you took your profits here at the top and then averaged down these, right? And slightly moved up their break-even points. You don't need as great of a pullback as you saw of a move up in order to, to zero out the position.
yeah, I think that was the biggest mistake. A lot of from what I was reading in the Discord, I think the biggest mistake was people were starting to move into bearish positioning while the market was trading flat, expecting continued downside. Um,
Yeah.
and but being at like sort of a midpoint, the prudent thing is to just kind of be conservative with any sort of entries while the market is trying to pick a direction. And so that's what I was doing. Like I just waited, and then once I thought it picked a direction. I entered, and then it started going up.
Yep.
So I was a little chasey. I held on to it for a reversal, and I assumed like a 70% risk on it anyways because I knew I was chasing.
Mm-hmm.
But then as it moved against me and it hit that threshold, I was like, all right, my upside hedges have been working, and this is starting to get really exuberant. So I'm going to start averaging down and just use the profits from the call side to do that. But a lot of people in the Discord, I was noticing that a lot of them were just absolutely getting wrecked on their puts on like things like Nvidia and stuff. When it's because they didn't kind of take a step back.
They're
And
not buying them at the top. They're buying them when price action flattens.
yeah. I mean, and it makes like strategy around buying around consolidation, but like seeing the kind of just taking an objective look at the trend, seeing whether or not these strikes you have are viable anymore, and making that determination as soon as you can, so that you can reposition. I mean, I pulled out of my Nvidia puts at like 230 because it was just not reversing quickly, which it would either reverse quickly or it's just going to continue. So I just got out, but a lot of people sort of they started averaging down, expecting a pullback. But the likelihood of a pullback in Nvidia is pretty low until the next earnings. So I think that a lot of people got caught, and now, especially with like April puts that should have purely been an earnings play,
Yeah.
they're now a reversal play, but the reversal, it's just likelihood super low. I just think a lot of people were definitely getting a little ahead of themselves, positioning really hard, getting fully positioned before any move was going to happen, which you don't want to be fully positioned before a move happens because that move could go either direction.
Yeah.
Right. So there was a bit of that, and I think some people, a fair amount were caught by that, and I don't know if they hedged or not, but that's definitely one of those points where you really have to take a serious look and think, did I fully position and now I can't hedge? Or, is this the time to hedge? Like, you can't fight the trend, even though you are fighting the trend, you really can't fight it all the way. A lot of people were doing that, and now they're sad, but hopefully a lot of people rolled, got a little more theta under their belt while their contracts were still worth something. Especially those low Aprils, like the April 170 folks.
Yeah, I haven't bought a new April on Nvidia in quite some time. I've been trying to, although May is really spicy and it's obviously very attractive. I've been trying to be responsible and just buy like June, September, and leaps. Which is less fun because you get less leverage, but it's definitely the smarter choice to have theta right now until you can confirm, right? And then you can scalp with shorter dated shit. Do you think non-manufacturing PMI tomorrow is going to be significant? I think if the numbers come in bad, given how overblown the call side is, that participants might make it more significant than it is.
Another thing with PMI too is contracting PMI with increasing PCE is stagflationary. So
yeah,
I don't know. Like we've had, I think now
we've had pretty consistent contraction in PMI across all the Fed reports.
Yeah, so we're having I just think that narrative is going to start creeping in if this becomes more pronounced and unemployment starts going up.
Yeah.
So,
Stagflation also really bad for equities. It sounds like equities will trade flat, not in this fucking range.
Yeah. No, it's just to give if you're trying to look at the PMI and make a macro conclusion from it too, that would just be if PMI continues to contract while these pricing measurements are continuing to increase. That's just a continuation of a stagflationary symptom. It's not classic stagflation, but it's definitely a symptom, and it reminds me at least to make sure I pay close attention to unemployment, because I think that is the final shoe to drop in the macro sense.
The unemployment? I think the unemployment leads to even worse things.
Well, yeah, but I mean that's like that's what's really going to send. We're not going to be talking about inflation anymore once unemployment starts going up, right? We're going to be talking about deflation. But if unemployment starts going up, the PMI and PCE and all those things all of a sudden gain way more importance because you're looking at a shift in the macroeconomic environment.
Yeah. Yeah, once the weakening in the labor market is going to be pretty important.
Oh yeah, well everyone's
here's what's like the deal though is, over the next 12 months, 16 months, people think it's bullish that the Fed is pulling back rates, but the Fed is pulling back rates as we become deflationary, and deflation is extremely bad for margins and profitability and the cost of finance and the credit markets. Like, it doesn't get more bullish when the Fed pulls back rates. It gets more bearish. Like, things get worse. It's not like it's a period of healing, if you will. But it's like a recovery, and it takes time, and I don't think any economist, as useless as they fucking are, is out there thinking that a recession isn't going to happen. There is going to be a recession. I think really the only thing we have a question of at this time is how long will it be? And obviously the Fed not being aggressive enough with rate hikes is something that could drastically prolong. Their inaction now can significantly prolong a recession in the future.
Right. You can imagine it almost like a lump, right? Like an impulse. And like the width of that impulse really is affected by the Fed's, damping via liquidity provisions, right? So the more they damp it, right, the more prolonged the bounce back, right? The response is going to be. So if they move too slow and keep things too loose, it's just over damped, and it means that the other side could be extended, right, because of their lack of responsiveness, or if they actually ease, heaven forbid. So it's definitely interesting, and I think that it will probably. I don't know if I want to say that. It'll probably be longer than people expect, especially with the credit market already tightening lending standards without even any sort of real. I guess there's delinquencies and stuff, but it's purely a response to these bank issues that people are tightening lending standards so they can reduce their risk. But the fact that it's starting now, right, without any real sort of big alarm bells going off in the credit market besides the volatility, it tells you that we're going to be in for a prolonged period of not only increased rates but tighter lending standards and higher APRs on any credit you take out. And the long-term effect of that is that these companies that could enjoy this cheap debt, they're going to get slowly squeezed for capital to spend for growth. And eventually some companies that have been using it not for growth, but just for value, right? I mean, there's plenty of them out there that, have derived their value from the ability to acquire debt. Yeah. They're going to start slowly dropping, small ones at first, but as this tight credit market environment persists, which especially because it started now, and the Fed is not going to cut rates this year, they say, like that you got yourself 8 months of tight lending standards ahead of you, and like as it drags on, as the attrition builds up, you're going to see small companies at first sort of having issues with debt, like Bed Bath and Beyond and stuff. And then further down the line, they're going to start getting bigger and bigger. And that's when the Fed's really going to be, in a tight spot if inflation doesn't meaningfully go down.
I just want to point one last thing out before this ends. In the bull market turnaround, after the COVID crash. In the first 7 days, we went up 20%. In the last 7 days, we've gone up 5%. In the first 30 days, after the COVID crash, we had gone up 31% on the S&P. So anybody who thinks this is like how a bull market begins, it's got a really long way to go, and it's getting there very, very slowly in comparison. So just to add maybe some confidence about where this can end up. Maybe that highlights things for people a little bit better.
Yeah, this has just been a big giant nothing burger for me that has just hurt my portfolio and made me make sad faces. But other than that, it's not really much else.
Yeah. All right, guys. Thank you so much for tuning in. Dork, thanks for being on. JFresh, if you're still listening, appreciate it, man. I'll have Pickle's picks out tonight for you guys. If there's any questions I didn't get to in the chat, let me know. I don't think a credit freeze is on the horizon, not at least not in the immediate future. Maybe a couple years or something, but I doubt it. Thank you guys, and I'll see you tomorrow. Have a good night, everyone.
Have a wonderful evening, everybody.
Kenny's Mayonnaise is a proud sponsor of Pickle Financial, so when you get a hankering for some creamy, delicious mayo after a long night of snorting, sweating, and pacing, grab some Kenny's.